Hello, I'm David Cassidy with the market update today, Thursday the 16th of July. The positive sentiment in global equity markets continued to build yesterday after the Philadelphia Fed President, Patrick Harker, said the Fed's 2% inflation target should be symmetric and therefore the US Central Bank should hold off on raising US interest rates until inflation is above its target. In other words, allow inflation to overshoot 2% before the Fed starts to take action. Now, given US CPI inflation is just 0.6 of 1%, this confirms what we have long been saying in these commentaries, that US monetary policy is likely to remain very loose for the foreseeable future. Data-wise, none of yesterday's important releases, the Empire State Manufacturing Survey, US industrial output and the Fed's Beige Book, had any hint of the US economy losing momentum, which suggests, as we said yesterday, that JP Morgan CEO Jamie Dimon was perhaps being too cautious in his economic outlook and as a result potentially kitchen sinking the bad debt provisions. In fact, US industrial production in June had its largest monthly gain since December 1959, when it rose 6.18%, following the end of a 116-day US steel industry strike. After climbing 1.4% in May, total output at factories, mines and utilities increased by a further 5.4% in June, which indicates that US manufacturing is bouncing back strongly as the economy starts to reopen following the coronavirus shutdowns. The Empire State Survey improved for the third month in a row from minus 0.2 to 17.2. 0 is the line dividing expansion and contraction, so a reading of 17.2 also indicates that the US economy is bouncing back strongly as the economy reopens. While the Fed's Beige Book also reported signs of improving demand growth due to the economic reopenings. This morning's Chinese Q2 GDP data also confirmed the economy is well and truly on the mend, as not only did GDP turn positive, it smashed economist estimates of 2.4% expansion by growing by a whopping 3.2%, while industrial production rose 4.8% in June. The only fly in the ointment was retail sales, which slipped 1.8% in June, although a deeper investigation shows this was predominantly due to car sales, as most other categories showed strong sales growth. However, UK and European equity markets have opened slightly lower this morning ahead of another large dump of economic data later today. First will be the European Central Bank monetary policy meeting, although we aren't expecting anything interesting to come from it, followed by US retail sales and the weekly US jobless claims data, and any further signs that the economy is recovering should help push equity markets higher.